Welcome to TradeLog AI Academy. In this lesson, we're covering failed break reversals, also known as the swing failure pattern, or SFP. This is a rules-based reversal setup that helps you stop chasing breakouts and start trading the trap. A failed break happens when price pushes beyond a key support or resistance level, but cannot sustain momentum and quickly reverses. The signature is simple. You see a wick outside the level, but the candle body closes back inside. That close back inside is the reclaim, and it's the first major clue the breakout is failing. Failed breaks reverse because they grab liquidity and trap traders. The initial breach triggers stop-loss orders beyond the level, creating liquidity for larger players. Breakout traders enter expecting continuation, then price snaps back, and their forced exits fuel the move. That's why this pattern often forms classic bull traps at resistance or bear traps at support. A real SFP requires three conditions, in order. 1. The breach. Price trades beyond a clear swing high or low. 2. The reclaim. A candle closes back inside the prior level or range. 3. The follow-through. Subsequent candles show momentum in the reversal direction. Miss one of these, and it's not an SFP. It's noise. This is the bearish version at resistance. First, price sweeps above resistance. This is the liquidity sweep that pulls in late buyers and hits stops. Next, the reclaim candle closes back inside, showing sellers have taken control. Finally, follow-through confirms the market is moving away from the failed auction and seeking value lower. Do not confuse rejection with acceptance. In an SFP, price is rejected beyond the level and closes back inside. Failed auction. In a real breakout, price finds acceptance. Candle bodies close outside the range, momentum holds, and the old level often flips into new support or resistance. The difference is not emotion. It's where price closes and whether it holds. SFPs work best in three environments. First, range boundaries. Range highs for bearish SFPs and range lows for bullish SFPs. Second, high time frame levels. Daily, weekly, or monthly support resistance carries more weight. Third, obvious liquidity pools, prior swing highs or lows that many traders are watching. The more obvious the level, the more likely stops sit there. Not every sweep is a trade. Avoid SFPs during strong, accelerating trends. Those breaches are more likely real continuation. Avoid major news events where volatility can power legitimate breakouts. And avoid low liquidity chop where patterns fail and price action becomes unreliable. Your job is to trade SFPs when context supports traps, not when momentum supports breakouts. You have two professional entry models. Model 1. Close confirm entry. You enter as soon as the reclaim candle closes back inside. It's aggressive and catches fast reversals, but can require a wider stop and risks weak follow-through. Model 2. Retest entry. You wait for price to reclaim, then retest the broken level before entering. It's more conservative with potentially tighter risk, but you may miss the trade if no retest comes. Your stop goes where the SFP thesis is proven wrong. Stop A is tighter, just beyond the high or low of the sweep wick. Stop B is wider, beyond the entire structure or SR zone, giving the trade room to breathe but requiring smaller size. The key is consistency. Your stop is not a guess, it's invalidation. Plan targets before entry. Target 1 is the first trouble area, often the midline of a range or the next clear SR level, where you can take partial profits. Target 2 is the opposite liquidity, the other side of the range, or the next major high time frame level. If momentum is strong, a small runner with a trailing stop can capture extension, but only after you've paid yourself. This filter boosts probability by aligning timeframes. Use the high time frame, daily or weekly, to mark the major SR hunting grounds. Then drop to a lower execution time frame, 4H, 1H, 15 mitters, to wait for the breach, reclaim, and follow through. An SFP that triggers at a major HTF level and confirms on LTF is a much stronger trade than an isolated pattern in the middle of nowhere. Mistake 1. Entering early, before the reclaim candle closes. Fix. Patience. No close, no trade. Mistake 2. Ignoring context. Trading SFPs in runaway trends or during major news. Fix. Check environment first. Mistake 3. Chasing wicks. Placing stops too tight at the level and getting stopped on noise. Fix. Respect invalidation. Your trade is wrong only if price takes out the sweep extreme. Here's the system. Identify a major HTF level. Confirm context, range, or exhaustion. Await the breach beyond the level. Confirm the reclaim close back inside. Choose entry model. Close confirm or retest. Set invalidation beyond the sweep wick. Define targets T1 and T2 and ensure RRR makes sense. Execute, manage, and log the results. Discipline is the edge. Remember the rule. SFP equals wick out plus close in. No reclaim, no trade. If you execute this as a process, not a feeling, you'll stop donating money to breakout traps. Log every SFP attempt in TradeLog AI so your decision-making becomes measurable and repeatable.